So let me ask you this. Are you kind of stuck on that treadmill, just trading your time for money? Or is your money actually out there working for you, even when you're asleep?
That's the big question, isn't it?
It really is. Today we're going deep into a book that, well, it definitely stirred things up and changed how a lot of people think about wealth. Robert Kiyosaki's Rich Dad, Poor Dad.
What the rich teach their kids about money that the poor and middle class do not. Quite the title.
It is. And we're going to unpack the main ideas, the core lessons, and see what financial nuggets we can pull out for you, the learner.
Yeah, trying to get some actionable stuff. Right?
Exactly. If you want to level up your money game, stick around. And hey, if you like these kinds of deep dives, maybe hit subscribe. We do more of these.
Good call.
Okay, so to kick things off, what's the absolute fundamental idea Kiyosaki hits us with right away?
Well, the biggest thing really is about your mindset, how you think about work and money. He says basically the poor and middle class, they work for money. Simple trade. Time for a paycheck.
Right, the standard deal.
But the wealthy, they figured out a different system. They make their money work for them. It's all about getting assets that, generate income on their own.
That story he tells early on about working for like 10 cents an hour, that seems key.
Oh, absolutely pivotal. He and his friend Mike, they're working for his rich dad in one of his stores for this tiny wage, 10 cents.
Practically nothing.
Yeah, and when they complain, which is understandable, the rich dad does something kind of wild. He stops paying them altogether.
Wait, he makes them work for free?
Uh-huh. But it wasn't about being mean or exploiting them. It was strategic. He wanted them to really feel what working just for a wage was like and its limits.
Okay. So confront it head on.
Exactly. He wanted them thinking differently. How could they make money their employee instead of the other way around? It was about sparking that mindset shift.
So it wasn't just this pays too low. It was more like, okay, if you don't like this game, figure out a new game.
Precisely. His poor dad, his actual educated father, gave the standard advice. Good grades, safe job, high pay, work for money.
The conventional path.
Right. The rich dad was pushing them towards something else entirely. Understand assets, build assets, leverage assets. He talks about the rat race.
Yeah, that cycle of earning, spending, debt.
Driven by fear of not having enough and, well, greed or desire for more stuff. The book is really about showing a way out of that cycle.
Okay, so lesson one. Get your money working for you. Don't just work for it. Escape the rat race. But that feels like a big jump for most people.
Yeah.
Which brings us to lesson two, financial literacy. Why is that so critical?
Because basically schools don't teach it. We learn math, history, science, but practical money skills, how money really works, mostly absent.
So we learn it at home.
Yeah, usually. And if your parents weren't financial wizards, you might just inherit their blind spots or bad habits. It just gets passed down.
And it's not just about earning more, is it? He talks about needing to understand the language, like financial statements.
Exactly. You wouldn't try to fly a plane without understanding the controls, right? Financial statements, the income statement, the balance sheet, they're the controls for your financial life. They tell you what's really happening.
Understanding cash flow, where it comes in, where it goes out.
That's the absolute key, according to him. Knowing that flow is crucial for making smart decisions.
This is where his definitions of assets and liabilities come in, and they're different. Not the standard accounting stuff. Can you break those down?
Sure. It's super simple, actually. An asset puts money in your pocket, period. A liability takes money out of your pocket.
Okay.
It's all about the direction of the cash flow. And this is where people get tripped up, like your house. Most people think it's their biggest asset.
Right. That's what you always hear.
But Kiyosaki often labels it a liability. Why? Because of the mortgage, the taxes, insurance, upkeep, all that money flowing out every month. It doesn't put cash in your pocket unless, say, you're renting out rooms.
Ah, okay. That's a big perspective shift. It's not ownership, it's cash flow.
Exactly. And he uses the balance sheet, assets, liabilities, equity to show the difference in cash flow patterns.
How so?
Well, the poor, their income basically just covers expenses. Money comes in, money goes out. The middle class, they tend to buy things they think are assets, like a bigger house or a nicer car, but these are often liabilities sucking up cash.
Increasing their expenses.
Right. But the rich, they focus intensely on building that asset column. Things like rental properties, dividend-paying stocks, businesses that run without them, stuff that generates income.
So their assets pay for their lifestyle, ideally.
That's the goal. Their assets generate more income than their expenses cost, so their wealth keeps growing.
He brings up those stories, lottery winners, athletes.
Yeah.
Huge incomes, but they go broke.
Yeah, tragic. But it proves the point. High income alone isn't enough. You need financial aptitude or financial intelligence, as he calls it.
Which is,
It's not just making money. It's
yeah.
knowing what to do with it once you have it, how to keep it, protect it, and crucially, make it grow and work for you. Without that, big money can disappear fast.
Okay, that makes sense. Which leads nicely into lesson 3, mind your own business. Now that sounds like starting a company, but he means something else, doesn't he?
Yeah, it's a bit broader. Starting a business can be part of it, for sure. But the core message is focus on building your asset column. That's your real business.
Not your job.
Your job is working for someone else's business, right? You're working for your employer, you're working to pay the government taxes, you're working to pay the bank your mortgage.
Mm-hmm.
The rich, Kiyosaki argues, focus on their own business, which is their collection of income-producing assets.
He uses that McDonald's example with Ray Kroc. That was eye-opening.
Oh, yeah, classic story. Kroc was asked what business he was in. People expected him to say hamburgers.
Right.
But he said, my business is real estate. Because while he was selling franchises, McDonald's Corporation owned the land under most of those restaurants. That was the real wealth builder, the appreciating asset.
So even within the hamburger business, his real business was the asset to land.
Wow. Exactly. It's about shifting your focus from just the income statement, your paycheck, to building that balance sheet, specifically the asset side.
Minding your own business means growing your assets.
That's the core of it. Financial struggle often comes from working your whole life just for a wage, building someone else's dream. You need to build your own asset base. Real estate, stocks, businesses, whatever works for you.
And he also talks about luxuries, right? The order matters.
Big time. He says the poor and middle class often buy luxuries first, usually on credit, digging themselves deeper into debt. The rich build their assets first, and then the income from those assets buys the luxuries.
Delayed gratification, but the assets pay for the fun stuff.
Exactly. Let your assets buy the toys.
Okay. Build assets, mind that business. Now, taxes. That feels like a big wall for a lot of people. Lesson 4, the history of taxes and the power of corporations.
Right. This one gets into how the tax system evolved and how the wealthy often use corporations legally to minimize taxes and protect their assets.
He talks about that Robin Hood idea, taxes starting for the rich.
Yeah, the theory was tax the rich. But he argues that over time, the tax burden really landed heavily on the middle class, too.
And corporations are the key difference. Not like a building, but the legal structure.
Exactly. It's a legal entity, just paperwork, essentially.
Yeah.
But it offers huge advantages.
Like what?
Well, two main things. First, tax advantages. A corporation can often pay its expenses before paying taxes. As an employee, you get taxed on your gross income first, then pay expenses. It's a big difference in cash flow.
Okay, pay expenses, then tax what's left.
Sort of, yeah. And second, protection. It shields your personal assets from business debts or lawsuits. If the business gets sued, they typically sue the corporation, not you personally. It separates things.
So it's a tool the rich use strategically.
Definitely. And it's not just for giant companies.
Yeah.
Even smaller businesses can potentially benefit, with the right advice, of course.
It's about knowing the rules of the game. Okay, shifting gears a bit. Lesson 5. The rich invent money. That sounds intriguing. Not counterfeiting, I assume.
No, definitely not. It's more about creativity and boldness. It means financial success often comes not just from being smart, but from seeing opportunities others miss and having the guts to act.
Financial intelligence lets you create deals.
Yeah, you invent money by structuring transactions, finding value, solving problems in ways others don't see. He uses that Alexander Graham Bell story, how Western Union passed on the telephone.
They couldn't see the potential. Missed out big time.
Exactly, lack of vision. Financial intelligence, Kiyosaki says, gives you more options. You see deals where others just see roadblocks.
Is this where his cash flow game comes in? Helping people practice seeing those opportunities?
That's precisely the idea. It simulates investing, managing cash flow, making deals. It gives you feedback in a safe space. It trains your brain to think like an investor, to spot opportunities.
He also says something kind of deep. Money is not real. It's what we agree it is. What's that about?
It's a bit philosophical but powerful.
Well,
Money paper, coins, digital numbers only has value because we all agree it does. It's a shared belief system. He uses this to suggest you're not limited by the physical cash you have. Your mind, your financial intelligence is the real asset. He tells a story about buying a house. I think it was listed at 75K.
yeah, something like that.
And he got it for $20 by being creative with the offer and financing, then quickly sold it for 60 tire. He basically created $40 K out of thin air through a smart deal. He invented that profit.
By seeing value and structuring the deal right. Got it. Okay, so be creative, be bold. But what about our actual jobs? Lesson 6. Work to learn. Don't work for money. Seems counterintuitive again.
It does, but it's about the long game. He argues that what you learn in a job is ultimately way more valuable than the salary, especially early on.
So focus on skills, not just pay.
Yeah, he talks about deliberately working in different parts of his rich dad's companies, sales, marketing operations, not always for the best pay, but to get a broad understanding of how business works.
Contrasting his educated dad who pushed for specialization. Become an expert in one thing.
Right. While the rich dad advised knowing a little about a lot, especially key skills like sales and marketing, he says many people fail because they can't sell or communicate effectively.
Overcoming that fear of rejection, maybe?
Big part of it. Financial intelligence isn't one skill. It's a combination, a synergy of accounting, investing, marketing, law, sales, all working together. So work to acquire those skills.
Learn constantly. Okay, so we have these great lessons, but knowing isn't always doing. He talks about overcoming obstacles, what stops people, even if they get the concepts.
He lists 5 main culprits. Fear, first and foremost. Fear of losing money. It paralyzes people.
How do you beat that?
He uses that remember the Alamo analogy. Texans lost the battle, but it inspired them to win the war. Failure isn't final. For winners, it's fuel. For losers, it's defeat. You have to be willing to fail and learn.
Okay, fear is number 1. What else?
Cynicism, that it won't work, it's too risky attitude, it blinds you. Analysis opens your eyes, cynicism closes them. Laziness is another, often disguised as being too busy.
The I don't want to fix toilets excuse for avoiding real estate.
Exactly. Instead of saying, I don't want to, ask, how can I do this without fixing toilets? Find a property manager. Then there are bad habits, especially spending habits.
Right, paying everyone else before yourself.
And finally, arrogance. Thinking you know it all and don't need to learn anymore. That's dangerous in finance.
And the I can't afford it trap.
Yeah, he says, that shuts down your brain. Ask instead, how can I afford it? That opens up possibilities and forces creativity.
So managing your own psychology is just as important as the numbers. Okay, let's assume someone's ready. They want to start. What's the practical advice in getting started?
First, he says, opportunities gold are everywhere, but you need to train your eyes to see them. And you need a strong why.
Reason.
Yeah, powerful reasons, your wants and your don't wants. What do you really desire? What financial pain do you want to avoid? That's the fuel.
Okay, cut your motivation.
Then, recognize time is your greatest asset. Keep learning constantly. Invest in your financial education, first books, seminars, courses, even before you invest actual money.
Makes sense. Learn before you leap.
And be careful who you listen to. Avoid advice from people who are poor or fearful themselves. Surround yourself with financially knowledgeable people, rich friends if possible. They offer insights and opportunities.
Information flow.
Right. Master one strategy first, real estate, stocks, whatever, then learn another. Don't try to do everything at once. And crucially, pay yourself first.
Allocate money to your asset column before paying bills.
That's the discipline. Build the assets first. Use good brokers and advisors, ones who actually invest themselves and know their stuff.
And that Indian giver concept, getting something for nothing.
It's about structuring deals smartly, finding ways to acquire assets using little or none of your own cash, maybe through seller financing, partnerships, or leveraging existing assets. Finding deals others miss, foreclosures, undervalued properties.
Making offers, being active.
Yeah, constantly look around, make offers, learn your market. He tells that story of his friend using real estate cash flow to pay for college tuition. It shows how assets can fund goals.
Using financial intelligence to create the outcome you want.
That's the essence of it.
So really the big takeaway is, it's about taking control, isn't it?
Yeah.
Shifting from passive employee to active investor, focusing relentlessly on building those assets and just never stopping the learning process.
You nailed it. Financial freedom comes when your money works harder than you do, and that takes financial literacy, building assets, and frankly, the courage to act and overcome those mental blocks.
Okay, so for you listening right now, here's a thought. What's one small thing, one concrete step you could actually do today to start shifting that focus, to move towards having money work for you?
Or maybe think about those 5 obstacles: fear, cynicism, laziness, bad habits, arrogance. Which one maybe resonates the most with you right now? And what's one tiny thing you could do to push back against it?
Those are definitely the questions to chew on. This has been great. Thanks for breaking it all down.
My pleasure. Always good to revisit these ideas.
Absolutely. And thank you for joining us for this deep dive. If you got value from this look at Rich Dad, Poor Dad, please subscribe, share it with someone you think could benefit.
Yeah, spread the knowledge.
Until next time, keep learning, keep growing, and start making that money work.